Everybody, this is Rob Kientz, your host with the Freedom Report. It's October 10th, 2024, a Thursday. And I was not here on Tuesday because I was a little bit sick under the weather. I'm just recovering. As you can tell, I still got a little bit of science stuff going on. So we're going to combine the economic and precious metals reports today like we used to do. So this will be a little bit longer. And there is quite a bit of data to go through. Some of this has to do with reports on inflation and jobs and the reasons why the Fed did what they did recently with rates. So we'll get into that. I'm going to go back to my book and teach you a little something about how a lot of the numbers have been played around with and modified. And then we'll get on to the precious metals report and look at the pullback that I expected to come, how it's actually not quite as bad as I thought it could be, and whether or not this will be the entirety of the pullback or whether we're going to have another uptick in the price of gold and silver. We'll get to all that, and let's get started and just dive right into it. So as I look at the economic calendar, initial jobless claims as reported this morning have spiked. Jobless claims last month were 225,000. Now they're 258,000, and that exceeded the economist prediction of 230,000. And I'll get to that here in a moment. We're going to spend a lot of time on jobs and inflation because those are the two big numbers that came out today. Consumer price index was 0.2% month over month. Same as last month, a little bit higher than expected. Core CPI 0.3%, CPI year over year 2.4% this month versus 2.5%, and core CPI 3.3% year over year, whereas last month year over year was 3.2%. So overall, inflation looks to be moderating if you look at the CPI numbers, and I'll tell you why you probably shouldn't trust those here in a moment. Looking at the markets, the bond rates are now what we would consider to be in a more normal territory. If you look at the difference between the 2-year bond or U.S. Treasury and the 10-year U.S. Treasury, they're no longer in inversion, although they were in inversion for over 700 days, over 2 years, which signifies we have an oncoming recession. That indicator's worked every single time it's happened. But the 2-year now is cheaper, a lower rate than the 10-year, which suggests that we're at the end of that inversion and the recession is coming. Overall, looking at gold and silver prices, we'll get to that in a minute. Let's look at Bitcoin and the cryptos. They're down a little bit today. As of time of this reporting, which is about 2:15 p.m. Central Time, Bitcoin's down about $1,662 to $59,338. Bitcoin Cash is down $3.27 to $320.14. Ethereum is down $61 to $23.53.99. Litecoin is down 91 cents to 63.97. XRP is unchanged at 53 cents. So basically, the cryptocurrencies have come down just a little bit. Overall, not too bad. The Dow Jones Industrial Index is down 158 points today to 42,353. The S&P is trading down 20 points to 5,771.87. The NASDAQ is down 30.65 points to 18,260.97. And the Russell 2000 Small Cap Index is down $20.89 to 2179.66. It had the largest fall percentage-wise of the day of down almost 1%, whereas the least amount of fall was in the NASDAQ at 0.16%. Overall, not too much going on with the stock market, but wanted to get you those numbers. Now we're going to talk about bonds, and I'm going to talk about this from a little bit different angle. This is a chart that I'm going to put up on screen that I showed probably 2 years ago, looking at 700-year bond rates. And there's a specific reason why I want to look at those, because we're going to look at a reversal of a 700-year history of falling bond rates across the world. Published originally 5 years ago in February 2020 by Dorothy Neufeld over at Visual Capitalist. She's looking at the 700-year fall of interest rates and why. And I'm going to walk you through this report again because it's been at least 2 years since I've shown it. Back in the day when you were looking at government debt, it had basically a nominal loan rate of about 15%. When you looked at the blend of them across the world, certainly you can see much higher rates and much lower rates. But if you blended them, it was about 15%. And this went all the way to about 2018. We had this strong fall in bond rates, which actually continued until very recently. So it's a 700-year reduction in bond rates. Well, why would government debt across the world, we measured all government debts for the last 700 years, fall for 700 consecutive years? What are the reasons for that? So if you look at her research, she says she collected data across 78% of the total advanced economy GDPs over the time frame. Schmelzing shows that real rates have witnessed a negative historical slope spanning back to the 1300s. Schmelzing was someone who collected the data, and that was written by this author. Displayed across a graph is a series of personal nominal rates. And if you look at the nominal rates in the 1300s, you had a 7.3, inflation 2.2, so the real rate was 5.1. If you looked at the 2000s, 700 years later, the nominal rate was lower at 3.5, inflation still 2.2. Amazing how that didn't change that much, and the real rate was at 1.3. So overall, the real and the nominal rates for bonds had come down over 700 years. What are the theories as to why that's occurred? Well, over those 700 years, we had productivity growth. In fact, in the article, since 1970, productivity growth has slowed. A nation's productive capacity is determined by a number of factors, including labor force participation. Pay attention to this, because I'm going to give you the labor force participation rate here in a moment when we talk about employment and economic output. If total economic output shrinks, real rates will decline too, theory suggests. Lower productivity growth leads to lower wage growth expectations. Lower productivity means less business investment. Demographics. Demographics impact interest rates on a number of levels. The aging population paired with declining fertility levels result in higher savings rate, longer life expectancies, and lower labor force participation rates. And the U.S. baby boomers are retiring at a pace of 10,000 people per day, and other advanced economies, which puts a downward pressure on real interest rates. Economic growth. Dampened economic growth can have negative impact on future earnings, pushing down the real interest rate in the process. Since 1961, GDP growth among OECD countries has dropped from 4.3% to 3%, meaning since 1961, the growth in the world economies has started to slow down. So it's a reversal of the reasons in which the bond rates would fall. Pay attention to what she's warning us back in 2020 when she's looking at this, saying we had 7 years of declining interest rate because of all these things, demographics, economic growth, and productivity growth. But since 2020, in the last few years, well, in 2020, she examined the last 50 years, and the rates at which those were increasing were now declining, meaning it was predicting that we would have a bond rate increase. In fact, it was predicting that we were going to break the 700-year trend. Why? Well, because the productivity growth has slowed down, demographics have become less positive, more in the negative category, and economic growth has slowed. So even though for 700 years, the general populace of the world, all the people in the world had experienced declining rates of debt, higher standards of lifestyle since the 1960s, according to this article, that had started to slow down. That's foreshadowing a reversal in the bond rates, which when I originally showed this a couple of years ago, I predicted we would have an increase in bond rates eventually. So let's go and look at the market yields for U.S. Treasuries. You can see that we've had the largest change dating back a very long time, dating back to, I would say, between the 1980 and 1985 in bond rates overall in a 5-year period. So if you look at 2020 to 2024, this period here, U.S. Treasury rates have risen the most since they've risen between 1980 and 1985. Well, what happened around that 1980-1985 timeframe? What you had was a couple of nasty recessions, and you had interest rates hit about 18%, which forced the Federal Reserve to raise inflation rates of about 18%, which forced our central bank, the Fed, to raise interest rates more than that, one tick higher, to bring down that inflation in prices. In other words, they made the cost of capital so expensive that the rate of monetary growth had to slow, and that brought inflation rates down. And there was basically a head and shoulders pattern. Leading about 1980, you had a spike in the rate of bond issuance. It fell, and then it spiked and peaked here. Basically, if I can get it, September 1981 at 15.84%. And then it had another little increase. That's a head and shoulder, shoulder, head, shoulder. And then it came down, and it's come down overall, even though it's had some spikes here and there. The overall rate in the U.S. has declined from about 1984, May of 1984, until the shutdowns in the pandemic in 2020. Now, after the pandemic, the rates have been rising, and they've risen the most since that 40-year time period. In other words, the U.S. Treasury rates have risen since the pandemic the most in 40 years. And this is a reversal of a trend dating back 40 years, but also a reversal in the trend dating back to the 700-year bond cycle, because the same thing is happening to bond rates across the world as well. Well, why is that the case? Why are bond rates going up? Well, if you look at the monetary system, we're in a debt-based fiat system since the 1970s. And you'll notice that you had higher rates on treasuries right in 1971 when Nixon took us off the gold standard. Money became pure fiat in the U.S. A lot of other countries had followed. We had that rise in rates and then a fall, but now we're rising again. That has to do with monetary creation. When you look at bond and money, money is created through debt issuance. And so you get a bunch of debt issuance that goes on the books as debt, and then X amount of dollars is created from that. And that's a fractional reserve currency system we live in. Well, what's happened to currency since we got taken off the gold standard. Since we got taken off the gold standard, we've seen an exponential increase in the amount of currency issued. This is currency in circulation according to the St. Louis Fed, not only in the amount issued, but the rate at which it was issued. It was a very flat since the creation of the Federal Reserve in 1913, all the way until we took the dollar off the gold standard. And then it was an exponential, almost hockey stick increase in the amount of currency issued. And that is why you're getting market yields higher now. Eventually, that money is sloshed around the system long enough to where it takes more than $1 of monetary issuance to equal $1 in increase in national output as defined by gross domestic product. And I don't have that chart up, and I'll show it maybe in another video, but it takes almost $2 of monetary issuance to get $1 of economic growth. And the bondholders and bond investors have figured that out. And that's why we're in this period of increased bond rates that's basically breaking the 700-year cycle, not only in the US, because the US didn't exist 700 years ago, but across the rest of the world, bond rates are rising. And now they're finally coming here to the United States. So we have some issues in the economic system. I want to go and talk next about inflation and employment, because the Fed recently stated the reason they cut 50 basis points on the federal funds rate was because they were seeing an easing in conditions in the economy. They felt like the economy is doing a little bit better. In fact, here is basically a 𝙁𝙍𝙀𝙀, the Minneapolis Fed president, one of the Fed's governors, state governors, commenting on why he voted for the 50 basis point decrease in the federal funds rate. Let's listen to what he has to say. This is at the Bank Holding Company Association Fall Seminar on October 7th. And he's basically going to be asked about this, and he's going to reply why he supported the decrease in the federal funds rate. Let's listen.
Great. Thanks for those insights, Neil. And let me begin with a few questions, and then we'll open up to the audience, and then we'll have kind of a trade between the audience and up here. First, let's start with the elephant in the room. In the September 26th, the FOMC voted to raise the Fed funds target rate by 50 basis points and lower it. I'm sorry. We're so used to hearing Rex saying raise. Thank you. Yeah. Voted to lower the Fed funds target rate by 50 basis points. Were you in favor of the move, or did you think higher or lower? Or, well, give us some insight into your thinking.
Sure. I did support the move. You know, over the past, first of all, back up for a second. The last 3 years has been incredibly difficult to forecast the economy. We were surprised that the inflation went as high as it did and was as persistent as it was. You might recall we called it, and I called it transitory, until we said, okay, that doesn't work anymore. It's not transitory. But then we were equally surprised by how rapidly it came back down. Now, prices didn't come down, but the inflation rate came back down. And so we raised rates, inflation came back down, and wonderfully, at least so far, the economy has been very robust, even though interest rates went up so high. You know, traditionally, when the Federal Reserve raises interest rates aggressively to bring inflation down, that slows the economy quite dramatically and can lead to a recession. So far, that has not happened, and the labor market has been very resilient. So there's every step of the way we've been surprised. At the early part of this year, go back to the very beginning of this year, it looked like we had conquered inflation, and markets were pricing in 7 25 basis point cuts this year. Then the first quarter of this year, inflation surprised us. It was stickier than we had thought. And we thought, well, maybe the disinflationary process is stalled. So then we paused. And then it turned out that the disinflation is continuing. And so now we've said, yes, we can resume with our planning to normalize monetary policy. This is a long, wordy answer to say, I supported the decision because we've made a lot of progress on inflation and because the labor market has shown some signs of weakening. And historically, when the labor market weakens a little bit, it tends to weaken by a lot. And we don't want the labor market to weaken by a lot. So I describe it this way. The balance of risks have shifted away from high inflation towards maybe higher unemployment. And that's why I thought dialing back policy was the right move. I could have supported 25 or 50 basis points. At the end of the day, the judgment was that 50 basis points was the right move, and I supported that.
Great. Can you give us your assessment of the overall economy?
Okay, so he said a lot there that I want to comment on. I mean, there's an absolute lot there that I want to address. The first thing that I love when Fed presidents talk about how monetary policy lags. And he says later on in this video clip how monetary policy lags what's going on in the economy. So they can implement monetary policy and it takes some time for it to take effect. In other words, they're always trailing what's going on. They're reacting to what's going on. And he said they were reacting to whether inflation was going up or down as to their monetary policy. That's an admission by the Fed. They've made 1,000 times that they don't control inflation, employment, and those types of things. They only react to what's going on in the economy. And when they do that, when something happens in the economy and they react to it, it eventually leads to an equal and opposite reaction. So if they're going to ease and make conditions for monetary policy softer, then what it's going to do, it's going to increase inflation and it's going to reduce employment. I don't know why they think that they can continue to control the economy by these policy adjustments. At the end of the day, the thing that really affects the economy most is the amount of money that's created in circulation. And, you know, we've shown you how much money was created. And ultimately what they're doing right now is trying to normalize policy and manage the economy based on faulty data points, which I'm going to get into. We're going to get into the point that CPI is a faulty data point. And we're going to talk about the CPI numbers. And then we're going to get into labor. And notice I'll be using labor force participation rate, initial jobless claims, and that type of information. We're going to talk about this in detail. When we've finished the analysis of those two things, then we're going to go back and look at the gold and silver markets. So let's get into a share screen here of a CNBC story that was out today regarding inflation. It's called, "Here's the Inflation Breakdown for September 2024 in one chart." It says the Consumer Price Index, that's the CPI, rose by 2.4% in September 2024 on an annual basis, according to the BLS. Inflation declined amid a pullback in gasoline prices and moderation in housing inflation. And there were some trouble spots, however, such as groceries and car insurance. So let's take a look at their chart. And this is basically just a chart of what's going on in the government numbers. I'm going to tell you that these numbers are completely messed up. And we're going to go back to my discussion on CPI here in a moment. Here's the inflation breakdown for September 2024, according to this chart in CNBC, which was generated from the BLS report on inflation. You can see that the biggest was eggs, increase at 39.6%, frozen non-carbonated juices and drinks at 15.3%, butter at 7.8%, and then everything underneath it. Food away from home, that means like takeout, restaurants, going to a festival, whatever, is at 3.9%, so on and so forth. Energy was down 6.8% overall, although electricity was up 3.7%. And all items less food and energy were actually higher. Motor vehicle insurance is up 16.3%. Video discs and other media, 11.6%. Photographic equipment, 10.7%. Gardening, 10.4%. Sporting events, 10.3%. Cigarettes, 8.8%. So on and so forth. Health insurance, 7.5%. So if you really look at the numbers, all of these numbers less food and energy are actually much higher than the stated CPI, meaning the other items that you pay for in your budget are going up much higher than food and energy. But we're going to look at why the whole CPI that you're looking at, you can't really rely on. And this is something that I wrote in my book. So this is a book I wrote back in 2009 and published in 2010. It's called Drop Shadow, The Truth About Our Economy and How You Can Survive the Coming Collapse. Don't pay attention to this website. It no longer exists, just for promotion of the book. As you can see, we wrote this back in 2010, and we got the book self-published. And I'm going to go down to page 32, and we're going to talk about inflation. Now, this is something I talked about in a video back about 2 or 3 weeks ago, but I'm going to put this back up on screen again. I'm going to keep pounding this lies about government statistics and why the government statistics are not trustworthy over and over and over again, so that you guys get it, because we do have new viewers come to the channel all the time. So in chapter 2, I talk about the manipulation of government statistics. CPI is not the only one I talk about here. This chapter is the longest in my book. It's 50 pages, and I'm only going to bring out the CPI stuff. Now, this is going to take a few minutes to walk through, so I'm going to go kind of quick. But if you want a copy of the book, you can go buy it on Amazon. And one of these days, I'll put out another free link. I did this years ago. I'll put out another free link because it's 14 years old. But the analysis of why CPI is off is still relevant, because we're talking about how they're calculating and tabulating the numbers, which hasn't changed since I wrote the book. Well, actually, it's gotten worse since I wrote the book, but it hasn't fundamentally got better. So if we talk about CPI, we're going to talk about the 4 ways in which the government has changed the how they calculate the CPI, and why you cannot compare CPI now versus 2000, 1990, or 1980, and certainly not back during the Great Depression, in the 1930s. Here, how the government has successfully modified the inflation measures. The first is substitution. Let me read this to you, and you can tell me in the comments and in the chat if you feel like The number that you're looking at for consumer price inflation, or inflation of the cost of goods and services that you buy every day, is the same as it was in 1990, 1980, and before that. So substitution is one way in which they change it, and here it goes. CPI rates have been amended since the Boskin Commission recommended that CPI values were overstated in the 1970s. The commission concluded that 4 factors affected CPI rates. The Boskin Commission told us that the real observed CPI is lower than stated. Government issued CPI because of quality change bias, outlet substitution bias, new product bias, and product substitution bias. So essentially what they're going to do is say the real CPI is correct, but because consumers can substitute other things, we actually need to misstate the CPI or round it down. In other words, if you had bought steak in 1970 and the price of steak had gone up, because you can buy chicken and it's cheaper, we're going to lower the CPI because you simply should choose chicken. No, I'm not joking. The rate of steak actually went up. They're just telling you should choose chicken and reduce your lifestyle. And because people, because the CPI numbers actually show the real raise in rates, the everyday raise in rates, but you can substitute, they're going to lower the number showing you that you should substitute. In other words, it's basically them telling you to change your lifestyle. Not that the rates aren't going up. They are. They admit this in the survey. But what they're saying is you should simply reduce your lifestyle because that's what government says you should do. Here's quality change bias. Failure to take into account the improved quality of machinery and technology and only accepting an increase of price a unit of a product. In other words, because technology is increasing our lifestyle, they're now going to back out that increase of lifestyle and pretend that inflation didn't rise as much as it said it did. Outlet substitution bias. When consumers go to discount or outlet stores and prices are cheaper than retail outlets. So in other words, you can't buy that name brand item. You have to go to the outlet store and get the cheaper one or the off-brand item because the real rates on the highest quality items that you want are going up. We're going to mask inflation and say they're actually going down because you should be substituting cheaper quality items. In other words, reducing your quality of life. New product bias, not taking into account other substitutes, such as watching a DVD instead of going out to the movies. Well, the price of going out to movies is more expensive, so you should be renting DVDs. So we're going to lie about the CPI and shift you over to renting DVDs because we don't want you to know that the cost of going to a movie is more expensive. And lastly, product substitution bias. Consumers buy cheaper items when higher end items get more expensive. This is what the Boskin Commission recommended. Things are getting more expensive. We don't want to print that number. We want to force consumers to have a lesser lifestyle, and we're going to print the CPI as if they had chosen the cheaper lifestyle, thereby masking the actual real day-to-day increase in the cost of goods that you buy every day. Essentially, the CPI only reflects the amount of lifestyle that you have if you reduce or the amount of price increase you have if you continually reduce your lifestyle to less than what it was before. They're basically trying to get you to choose a lesser quality lifestyle, and that's what the statistic is. It is not a statistic that shows the true actual price increase of goods and services, and it hasn't since the 80s because of the Boskin Commission. I wrote in the book, the first and most obvious point to make about the Boskin is that in all 4 issues reflect the trend of consumer to purchase downward as inflation affects their pockets. I don't understand in what parallel universe that members of the Boskin Commission existed when they made these recommendations as a reason to lower the CPI. Look, if prices are going higher, so we're not able to afford the same goods we used to buy, then that means we are losing purchasing power. That is not a reason to understate the state of CPI numbers. When you modify CPI to take these into account, you obscure the fact that the prices are not actually falling, resulting in lower inflation. The prices are rising, in fact, faster than incomes are rising, and the consumers are just adjusting their purchases to inferior goods because they have no choice in many circumstances. If you go on to read the rest of chapter 2, I show that wage increases have not kept up with inflation. And that's why consumers had to buy cheaper goods. And that the CPI measure today is not measuring actual real rates of price increase. It's measuring the percentage of which you need to reduce your lifestyle because prices are rising because of all that monetary inflation that we see here since 1971. Notice that the Boskin Commission came out in the 1970s and they were saying, we're having inflation. We need to adjust these numbers. And they've continued through 80s and 90s and even today to change those numbers to mask the fact that they're printing more money. Okay, get the picture? For example, I go on to write, the product substitution bias data point seems to confirm this. As items get more expensive, consumers are required to downgrade. This should not adjust the CPI level down at all. It should be recognized by our government and, more importantly, by the people that inflation has become a problem that is eroding our purchasing power. The quality change bias emphasizes the increased efficiency of machinery, but ignores why the overall price of the unit may still be higher. If the unit price is higher despite better efficiency, then one can reason that the prices of other inputs have subsequently risen. Otherwise, prices would fall with all other inputs being equal. The total inflationary impact is therefore correct when all input factors are taken into account. The quality change bias is not a bias at all. The Boskin Commission just did not examine all price input factors and instead to concentrate on only one of them. A common public criticism of the Boskin Commission is that it did not take into account that while buying inferior items reduces cost, it also reduces quality of life by the same corresponding amount. If the Commission removes this value from CPI, then the CPI would have no value in measuring quality of life services, such as social services, should not be used to adjust tax brackets, and should not be used in cost of living wage adjustments. Basically, the Boskin adjusted value of CPI should be scrubbed completely because it's useless. What it does is it masks inflation and allows the government to reduce the quality of social services such as Medicaid, Medicare, Social Security, all those types of things due to inflation. Not only are you getting less value for your buck at the grocery store, at the auto store, online at Amazon, you're getting it in the healthcare system, and you're getting it in the ability to retire. Social Security will never be worth what it says it's worth because of inflation, if it even exists for my generation all, because this is the last couple of years is where it went bankrupt. It went negative to where we're actually putting less in than we're taking out. That's the demographics of the retiring baby boomers, and the inflation has eroded the power of the dollar at the same time. And I go on and on to talk about this. There's also these things, geometric weighting. Another way in which your government has manipulated inflation numbers is through a process called geometric weighting. When certain goods get more expensive, they're weighted less in the government CPI numbers because it's assumed by planners that people will buy less of said product. Another way that they mask the rising prices of goods is to say, well, if cars are more expensive, we just reduce the amount that they're in CPI because we assume you're going to buy less. Again, it's covering the amount of dollars printed or raising the cost of goods, and therefore forcing you into cheaper quality of lifestyle. Further reading, the items suffering less inflation are also weighted more heavily in the calculation. Geometric weighting keeps total reported inflation down, regardless of true market choices of consumers and sellers. And like substitution, it hides the obvious fact that if some goods continue to rise in price, higher inflation is a result, which leads to lower quality of life. If you got to buy your meds, you got to buy your meds. You can't substitute. If you have to drive to work, the only thing you can get is a cheaper car. You still got to drive to work. You still got to wear clothes. It just means we get a lesser lifestyle for the amount of dollars we're earning. And remember, wages are rising less than the amount of monetary creation or inflation. So you're always on the losing end as a consumer. You can never get ahead, period. And that's why the baby boomers largely are coming back in the workforce. They can't retire even with their $1 million portfolios. $1 million is not worth today what it was before. And all those investments into 401ks and pensions are not allowing retirees to retire, and they're working later and later and later. And we'll see that in labor. We'll see that and other statistics in the labor force participation rate. Hedonics, another way that they've adjusted CPI. This is where CPI manipulation gets really subjective and ridiculous, I write. Hedonics is the made-up measure of the additional happiness of a good we get from technical innovation. There's no math behind it. It's made up. It's fantasy. Say, for example, a 30-inch flat-screen television cost $600 in 2007. If one buys another television the same size in 2009 for $650, we can say we had inflation of 50 in 2 years. However, the government does not see it this way. The government estimates that because the 2009 television has quality improvements, such as increased resolution, the benefit from the television increases. It's your made-up happiness quotient that they're assigning to you without polling you to say whether you actually agree with this. So I go on to talk about the consequences, and I go on to talk about interest rates. One other thing, a Business Week article I wanted to reiterate. This is one of the articles that I researched, written by Gene Koretz. That Business Week article goes on to note, as a result of all these adjustments, the ones I just went over in the book, the reported rate of inflation in 1999 will be about 3/4 of a point below what the old 1994 yardstick would have shown, and perhaps more. But since the government is not going back and fixing the past data as it makes changes, the effect is to bias inflation downward when compared with previous periods. That's why you cannot compare inflation in 80, 90, 2000, and now. It doesn't work. The numbers aren't the same. The calculus of the math has changed. And so you don't know the truth based on the numbers, They've lied and lied and lied and lied. So when we look at that core CPI inflation this month of 2.4, it ain't 2.4. And I'll show you that here in a minute. This helps explain the current situation where growth seems high and inflation seems low. We have a positive GDP number and inflation seems low. But wait a minute, our lifestyle is not getting better. It's getting worse. It's getting worse. That's how they do it. That's how they fool you. That's why you got to know the truth. So I go on to talk about more articles and solutions and all sorts of stuff like that. I go on to talk about shallow stats. I want to talk about this table for a minute. Let's say they misstate the CPI. This is your multiplier table. This shows that a gradual increase in something, let's say price goes from $1 to $1.05 next year and then to $1.10. Will it increase 5% the first year and then a certain percent the next year? And you have to add that inflation as a base cost back in. So inflation, in other words, or the rising rates are always an exponential curve. And in the first few years, inflation doesn't seem to be as bad. But when you're adding inflation on top of inflation and building that base number for the next year and then building it again and again, it becomes a hockey stick that goes straight up. This is indicated by this inflation multiplier table I'll put in the book, chart 2.1. If the rate is 4% inflation in year 5, prices are 1.217% what they were in year 1. In year 50, they're 7.107 times. So in 50 years, if you had a 4% inflation rate, your prices are 7 times higher or 700% higher than they were when you started. Well, let's say the inflation rate is 6%. In year 5, you're now at 1.33 times, but in year 50, you're 18 times the price. So if they're misstating inflation by only 2% over 50 years, you've seen more than a doubling of your prices. And that's why the inflation numbers don't make sense and why your standard of living is coming down, because since 1971, which by the way is 50 years ago, the inflation rate has been misstated since they began modifying these in 1980. What if it was 9% base inflation rate? Well, in year 5, you're at 1.5 times prices. See, 1.5 is not all different from 1.2. In 5 years, you're not going to see how that inflation is absolutely destroying your lifestyle. But what about in year 50? You're near 74 times higher prices than you were in year 1. Well, if inflation was only 4% a year, you only paid 7 times higher prices. If it's 9%, you're paying 74 times higher prices. This is why when they mask inflation rate down, over time, it masks in an economic or an exponential rate, how much you're actually losing and how much it's destroying your lifestyle. You can go on and talk more about that. One last thing I want to show, chart 2.2 is talking about annual rate of change in prices. It's talking about deflation in prices versus inflation. And this inflation rate right here in this column, you can see if it has parentheses around it, we're actually having price deflation. This is on the gold standard. If it's positive, you're having price inflation. So in 1812, when the War of 1812 started and we started, spending all this money, rates of prices of goods went up. Why? Because the money supply increased. The amount of spend increased. They started introducing scrip and stuff like that. Prices went up. But we're purely on the gold standard. You notice prices almost always go down, because on the gold standard, you don't have rampant printing of money. Technology increases our lifestyle, and that comes back to the people that save in gold. Okay. The only times at which during the gold standard that inflation ticked up was when we're in War of 1812. And you see all these numbers, and these are added. So I'm using 1800 as a base. When you add all these numbers, you're getting this increase in lifestyle of 63% in 1849. But then we had the Civil War, and a couple of years after the Civil War started, we started having an increase again. Why? The greenback, monetary inflation, substituting fiat for gold, you have inflation. Well, then we had disinflation again, or deflation in prices again, all the way through until the creation of the Federal Reserve Bank in 1913. All the way through. The only time in which we had significant price inflation dating back to 1800 was when we had the War of 1812 and the Civil War. Those are the only times we had positive inflation until the creation of the Federal Reserve. Now watch all these numbers go from negative for over 113 years to consistently positive. In 1918, 7.6, 22.5, 38.3 in 1920. All positive numbers with the exception of 1933, when you basically had the deflation of the entire economy. All positive numbers. And when you get to the bottom of the index, you're looking at a huge number. Gold exchange ceases, 1971. And this is through 2009. You had a 285% increase in the price index. So with the exception of wars on the gold standard, you didn't have an increase of prices. You only had it when you spent more to pay for the war in the form of scrip or banknotes, and then eventually the greenback in the Civil War. And it wasn't until 1913 we issued paper currency that you saw a steady and protracted and non-stop increase in the prices of goods, thereby lowering lifestyle. This goes back to this chart. Until this point in time, 1800 and 1900, we didn't have an increase in prices because we didn't have an increase in the monetary supply, with the exception of the two major wars. 1971, when we came off the gold standard and gold was no longer regulating the amount of currency in circulation, we've had an explosion in currency and also an explosion in inflation, as you can see on this chart. And this is from the Minneapolis Federal Reserve numbers, by the way. These are government numbers. This is inflation before we go back and remove all the funniness. So this end number of 285.7 in 2009 would be much higher if we were actually using real inflation rates. We're not, because if you go back to the book, we're using all these goofy measures. And if you really want to know, using the traditional inflation rate with all the stupid changes they've had since the Boskin Commission in the late 1970s, our official inflation rates are actually much higher. This is blue number here that you can see on shadowstats.com. John Williams, who runs ShadowStats, has done a reversal of those changes back to the 1990 numbers and the 1980s. Before the Boskin Commission, this 1980 base number was the real inflation rate. And you can see it's much higher, the blue line. And they made more changes in the 90s. It's much, much higher. So as the government has changed these numbers, it's brought down the perceived inflation quite a bit. And that's why you can't trust the government numbers. Okay, you get it? All right, that was a long piece. Let's go now to jobless claims. We've seen the highest spike in jobless claims dating back to 2021. Jobless claims had come down. There were a little bit of spike around 2023, but it didn't last. This most recent number from September to October, this almost straight up line you see right here on the tail on the right-hand side of this chart, in jobless claims, initial jobless claims of new jobless people, is the highest increase since 2021, when you saw it back here between beginning September and the end of September. 4 years ago, we had a high rate of increase in jobless claims, but it came down. Now it spiked again. Jobless claims are going back up. But wait a minute, I thought unemployment actually went down. How can unemployment go down when jobless claims go up? Well, that's because the number that they use. Here's the labor force participation rate. The only number that you need to know in unemployment is this one. Labor force participation rate is the most pure number of labor force participation. It measures the amount of able working adults versus the amount of able adults that can work in society. It is the truest measure of job rates. And you can see that we never recovered from the pre-pandemic recession job rates. We were sitting at 63.3%, as you can see on the chart, as I've highlighted back in February 2020. With all that money creation, look at all this money creation since 2000. Most of the money ever created in the United States and in the world, as a matter of fact, when you consider China, all these other advanced economies, occurred since the pandemic. But it hasn't increased employment to where it used to be. We've created more money in the last 4 years than we created in the history of the world. And we haven't even gotten employment back to where it was before. So when Neil Kashkari says we're worried about employment, that's why. But let's look at the chart dating all the way back to since it was kept. We peaked in employment back in 2000 before the tech crisis. It's never recovered. And when there's a sharp decline in labor force participation since 2020, and it's still never recovered. And even though this period has been the biggest amount of debt and money creation in history, that is why, ladies and gentlemen, we're reversing the 700-year bond trend. And that is why bond rates are starting to rise on this chart, is because currency has risen the most in history, but labor has not kept up, and neither have wages. And inflation has increased the most, but the government is covering it up, as I showed you. So that's the economic part of the report. Let's go to gold prices. Today, gold's up today, $20.21. Yay. Silver's up 64 cents, up as a percentage higher, 2% to 31.13. But you can see the downturn here on goldprice.org. You know, dating back the last 30 days, gold and silver prices are lower. They're actually lower over the last 10 days. And so this is the pullback that I was starting to talk about. When I said we finally had that gold and silver breakout, we did. But because gold had run so hot for so long, I was expecting a pullback, and that's exactly what's happened. Let's go over the open interest, the derivative markets, which is how prices determined for gold and silver. In the US, we're going to do this real quick. Nice moderate amount so far in October. Open interest has actually decreased on the markets just a bit. We can see here that total volume as of this morning, so yesterday's data was 55,000 gold contracts. No, I'm sorry, this is silver. Let's go to gold. Okay, 154,000 gold contracts out of a total open interest contracts of 521,836. The change was a positive 1,520 contracts. You can come down here and see that the contracts are rolling off of October and even December and already starting to move into February and April, which are the two contracts that have seen the biggest increase. You can see over here in the right-hand column. So they're actually starting to move the futures into February and April from December, but December has the highest amount of contracts. And when we get to delivery, the first few days of the month, we'll see huge deliveries, typically in physical deliveries. Overall, if you look at EFP, 1,719 contracts were moved yet from yesterday's data from COMEX in the US to the OTC market in London. Why? People are hunting for the gold there or better gold prices, because the COMEX tends to have the weakest price out of all the major exchanges when you talk about COMEX versus London versus the Shanghai and China and other less robust markets like the Russian and the Dubai and Japan. Clearport and the block trades and the trade after settlements. These ones at which trade in blocks and they kind of come onto the market, they're not live on the market, but they're traded in blocks or after settlement and put onto the market, has been increasing. And that's because I think people are seeking less volatile prices. So they're trading sort of off market and bring it back on. Pre-approved trades onto the market, trying to clear with a little bit more stability, because the prices in gold and silver are much more volatile than they have been in the past. And I said that dating back about the third quarter of last year, about a year ago, I said this would happen. We'll have more volatility in gold prices. And that's an indication that you can see the Clearports, the block trades, and the trade after settlements have been increasing. The numbers have never been this high. It's because of volatility. People are trying to settle outside the volatility of the open market. And there are ways in which they can do that. And that's why you see that trade increasing. All right, we're going to go over to silver. Sorry, that was the first chart. Total volume of 55,966. Out of total open interest, 145.51. You saw not made deliveries, only 16 contracts delivered. EFPs to London, only 200 contracts. Clearports, 378. Trade after settlement, 805. Block trades, 178. Again, the off-market trades agreed to and put on the market at a single time to avoid that volatility of pricing has been increasing also in silver. Let's go on to look at the COT report. Last week, I did that nice bar chart of the visual of the COT report. This time, I'm going back to the table. I just want to show you what's happened in the last week. And the table allows us to zoom in week to week versus the bar chart's more of a histogram, a longer term. So we're looking just week to week here. So as of through October 1st, again, 9 to 10 days old, this report's always in arrears, but this is the latest report right off their website. So you can see up here, CFTC.gov. You can see that the swap dealers decreased their shorts about 1469 in silver. This is silver on this table. And they also decreased their shorts by about 10,243 in gold. They decreased some of their longs as well in both categories, but they decreased the shorts more. That's what allowed the price to be a little bit more buoyant lately, and their short covering. I said that when the price comes down, let's go back to the gold and silver price. When the price comes down, the shorts are going to cover, and you're going to see those shorts removed from the market. Here is the silver shorts removed by the bullion banks. Here is the gold shorts removed by the bullion banks. They're so heavily weighted short in gold, 295,000 contracts to 42 long, and in silver, 65,000 to 23. And they have the highest concentration, as you can see at the bottom tables on the charts, that the banks and their clients that they trade for, it's not all the banks' position. Some they're trading for clients. They're getting a little antsy because these prices have been going up. If you look at the 6-month trend on gold and silver, it's been decidedly higher. At the same time, look at these prices over the last 6 months. They've been going up. At the same time, the banks have been increasing their shorts to these record levels, or at least record in the last 5 to 6, 7 years. So they had to short cover. So they had to have prices come down so they could release some of those shorts and remove the pressure of their balance sheets on their trading desks. All right, let's go on to gold chart. We can see, as predicted 2 weeks ago, I said we had reached a breakout in the 50-year gold and silver market. If we break it out to an all-time, you can see here's a 50-year breakout. It's the last Fibonacci. You know, if you go to a shorter term chart, you can see this coming down. I said we'd have a retraction. We did. Is gold done with its temporary pullback in this bull market? I don't know. I honestly don't. When looking at the action on the COMEX, it seems like they're still weighted, the bullion banks, too high to the shorts, but we did see the financial houses decrease their longs. And so that is an environment in which you could see gold and silver come down more, because at the same time, the bullion banks, the sharps, as I call them, are reducing their short position. the hedge funds, the ones that are always the victim and lose money in this market, are reducing their longs. That means that the bullion banks could continue to reduce their overall shorts and bring the prices down. So you could still see gold and silver tumble down just a bit. Although, as you can clearly tell, we're still in an uptrend. And I called it. I said 2 weeks ago and last week, I said, expect a pullback. We got one. Are we done with a pullback? I'm not sure. There's so much fundamental geopolitical risk in the market that gold and silver could continue to run. I know for a fact that other sovereign nations are trading on the COMEX, so they could continue to take long positions and push it up. But the bullion banks are so short that they may put increasing pressure on the downward side of the market, so you could start to see that come back. Silver has come down even more than gold did as a percentage, but you can still see it's still above this critical $30 trading level on this Fibonacci or this trading line. So it hasn't broken down through support. You've had a double top across. You basically now had a head and shoulders. You've had up, up, and up, although this shoulder is higher. That's actually a bullish sign. When you have a head and shoulders and the right shoulder, where the most recent peak is higher than the previous two, that's usually a bullish sign, not a bearish one. So that means that silver is probably still in a bull market, but it could pull back down. If silver pulls back down in the $24 to $30 range, it wouldn't surprise me. I don't expect it to come down below 28, 29. It could, and it depends on how badly the bullion banks need to remove some of those shorts off the market. So that could happen. So expect that we could continue to have some weakness in the gold and silver markets. However, if you look at what's going on with the rest of the market, obvious recessionary concerns, obvious deflation in the economy, obvious increase in the price of the economy. We have stagflation going on right now. Obviously, increase in the worry over the labor market, as Kashkari stated, and why they really cut. Inflation is higher than the CPI. I showed you that. But what's getting worse is actually labor market conditions. In fact, it's never recovered since prior to 2020, and it's never recovered since prior to 2000. The last three recessions, labor force participation has never gone up. Labor has been in a decline for 24 years since the dot-com crisis, and inflation has gone up over that time. The standard of living has eroded, as I showed in the book. We're now in a bad spot in the economy where I don't see things getting fundamentally better, at least over the medium to long term, for the next 4 or 5 years, maybe 10. It's going to take a long time to clear all this debt. It's going to take a long time to deal with all the inflation coming back to us as the rest of the world de-dollarizes and shoves all that monetary creation, all those dollars back at us, which is going to raise prices. If in our economy, we have more dollars coming in from overseas and more printing domestically, that has increased higher than the GDP, which it has. Monetary creation has increased much higher than our gross domestic product, our production. That means prices have to continue to rise. And that's going to cause a deflationary pressure on the economy because we have so much debt and we can't take any more debt. And it takes more than $1 created to create an additional $1 of goods and services. So we actually have to crash down a little bit before anything else happens. So that's what I expect to see. This has been the Freedom Report from Rob Kientz, your host. This is going to be the only video we do this week, just recovering from getting sick. Been a long one, about 45 minutes. Appreciate you guys being on. Until next time, Rob Kientz with the Freedom Report. We'll come back next week.